Welcome everyone. How we doing? What's up? Just hanging out. Pretty fun day overall today. How'd everybody do? Hope everybody had a good one. It was a pretty fun one, man. You could have been really right and ended up really wrong by the end of the day, or really wrong up here and end up right, or really wrong somewhere over here and end up really right over here, you know. Good day for both sides. I love it. I mean, this market's just been ridiculously fun. My buddy Lambos, I don't know if he's in here, but he keeps making fun of me because got here about somewhere like back here. I said, oh, don't get used to these $5 days on SPY, like they're gonna go away. And I don't know if we've had a day that moved less than $5 since I said those words. So I even talked about it on Sunday. Let's keep this going. I love this volatility. This is like the best situation for us as day traders. This is the type of movement we want to see in charts when we are day traders. Unless you're on the wrong side of it, then oof, you hate to see it. Oh no, market's got plenty of direction, bud. Just zoom out. Direction is up. No questions asked. Direction is up. And yeah, you can make the argument for chop, but like I'm sorry, give me some chop in a 554 to 564 range. I will take it. A $10 range, like that is like the ultimate gift. If you're a breakout trader, of course, you're probably not loving life, or a big swing trader, because we see a lot of it in OT where people are up nice, so they decide to swing on the trade and they, frequently run into issues doing that if the market isn't just pointed straight up or straight down, because, that's what we've had lately, like big green, big red, big green, big red, big green, red, over and over and over. So, and then even today was a prime example, everybody was screaming, I'm swinging puts, I'm swinging puts, I'm swinging puts. And by the end of the day, they're suddenly swinging calls. But yeah, I mean, people are having trouble with this. And I think I am just lucky because I don't swing trade. I just, I scalp and I day trade and I mostly trade SPY and QQQ. And so how I trade, I like to treat it as either I'm right or wrong instantly, no issues. I took a couple stop outs today, hit a couple nice trades today, that's just the name of the game. But you just have to be comfortable in trades and then read the market and understand what the market is telling you. And it's what I was saying, there were some people that were getting long and then got obliterated, or by the end of the day got to celebrate some profits, or people that were short and then getting blown out and then ultimately get to celebrate profits. For how I trade, this isn't ideal. This isn't ideal for how I like to trade, just because there was a little too much up and down volatility. But market's been disrespecting levels like nobody's business, and so it's always been, it's been good for me. Oh yeah, I see what you're saying. You always get out and the trade goes the right way. Well, that should tell you one thing: your entry was wrong. That's just the unfortunate fact of it is, we trade options. So time is not on our side. So you need to be right in a timely manner and you need to admit you're wrong in a timely manner. Like if people were short here, there was no reason to stay in these trades on these big breakout candles. Then when you finally do see a nice bearish candle closing below a previous low, we know we got this big 547 level right here. You can take that risk on shorting it again. But if you're trying to short all these bounces up and it's just not working for you and then you get blown out, you just got to admit you're wrong and move on. And then, look for some sort of bearish reversal and try to short the first bounce up. And this I didn't catch this today or anything, but like what a beautiful entry on this bounce up. You're going to be risking 20 cents upside. If you want the wide stop, you're going to be risking less than $1 of upside against you to ultimately catch, the only trade you needed for the day. But it's all about just that patience and, deciding what you want to do and waiting as long as you can for the best entry you can get is that's what I always recommend. Yeah, and that's the thing, all these people that were shorting this, it was fine if you were shorting 547 because you were making money, but most people won't take that money, and they'll get chopped through this. Maybe they'll take it once they get this move down, but this is going to pay you a nice 20% on a contract, 25% on a contract, and then you're going to give it all back and likely go red. And then this one's probably only going to pay you like 18%. Then you're going to give most of it back again, just as theta is working on your contract and, the IV working for you, working against you. And so, trading in something like this is not ideal. If you're trying to, catch a bigger move, you need to wait for those moves to come. And, everybody was trying to short this. And then the main thing that I was pointing out was wait for this little trend to break and long the retest, and catch that bounce up there to 547 again. Then if you want to short it, no problem. Well, there was one of your first issues. You're in 543 puts, so you were so far out of the money, you needed a big move for those to do much for you. I didn't even look at IWM today, if I'm honest with you. I mean, looks like most other things. That one even a little bit cleaner. I'm so sad I didn't hit this down here though. Still, that one's haunting me a little bit. That thing was tradable today, huh? Yeah, won and lost on it though. Could go crazy. Yeah, no problem. And I mean, just to I'll just give you a real quick example of why you might, want to start considering. I think I have that one used. There we go here. Why you might want to start considering going at the going at the money is just to give you a little example right here. So let's see, SPY. Oh, yep, they're still on there. Okay. So let's see. I would have been definitely looking at like 546s. So on these 546 puts here, you can see that, while it is chop and while it is like hard to make money and, ultimately this nice big move comes, well, we can see that this, and let me get rid of all these indicators so I don't have to look at them. And for anybody who doesn't know, or this isn't part of the lecture, but this is the option contract. This is how, you look and see what the contracts are worth. So this type of movement is not ideal for, what people like to trade in really. But you can see all of these bounces, if you're shorting these bounces, these contracts are going from $90 to 130, 120, so you're getting each one of these candles that you bounce and it shorts is a 30% trade. And it's a nice return, I mean, people should not say no to a contract going from 93 95 up to 120 130. You're getting that over 30% trade in one candle, and it really makes it worth it. And you have the safety of if it goes a little bit against you, then you can still either, if it doesn't go too far against you, you can still make money because you aren't way out of the money, or if you do have to stop out, it's going to be a much smaller percentage. Whereas if you're in something like these, these contracts are going to look very similar. You're making, let's see, $10 per contract, and that's it. So I am always, always, always going to go for the little bit of extra money and little bit of safety. You'll see, sure, oh, they're cheap. You'll see that you're making a similar amount of money as long as you're sizing the same. Those contracts are whatever, $90. These ones are, well, $35. So it costs you a little bit more to get 3 of them, but you'll come out with a similar amount of money. But the 546s are going to be super easy to sell and people are going to want them. And I mean, even look, like you'll get these random weird wicks, but it's not really, it's this candle. And again, if we go back to those 546s, you ran those things deep in the money, and so you would have taken them from 95 to 164 or whatever. So you were good, so that's why I always recommend going at the money. You'll have that safety. If it goes against you, you're gonna lose less percentage and dollar wise. And so it's a little bit easier to make money with those. It's definitely safer in case it goes against you. And so I always recommend those at the monies if you can. Ooh, give me 1 second. Yeah, and with the zero DTE, you always want to go at the money. I mean, or like one strikeout, if we're trading at 545.90, you're safe enough going 547s, but if you can afford the 546s, if you do catch that nice move, that delta is going to pay you. Okay. And give me 1 more second. Yeah, no problem. Okay, with that, we will get rolling. Welcome everybody, Dirty River. Happy to have you. Gonna be talking the opening range tonight. I get questions about it all the time of people not understanding it, not knowing what it is, not knowing how to chart it, and not knowing how to use it, even though, I post in my tab every day. And a lot of those same people ask me for charts every day. And so this is just something that I really like to use. It's very simple to chart, and it just gives you some information based on real statistics, not your garbage like Twitter furu statistics nonsense. This is real statistics based off, you know, 40 years of experience from Al Brooks. Plus, they paid a bunch of money to more research to do a bunch of back testing on it as well. So this thing has, really decades and decades of back testing done on it and the statistics behind it. And so I love to use it. I use it every single day. Not only do I base trades around it, just right off of the opening range, there are trades that I will almost always look to take if they present themselves, and they have a high probability, they have a good success rate, they have very low risk, generally speaking. And so I like to use them. I use it every day. And as I said, I use it for actual trades. And then I also like to use it for just understanding what the overall market is doing, some things that, I like to look for. Maybe, one of the ones that we're going to cover tonight is, using it as kind of a tool to call the market's bluff. And we'll get into that a little bit later, of how I use it to, maybe say the market's selling and I'm looking to get long, or maybe say the market is buying and I'm actually looking to get short, because I can pull up the opening range on a few charts and very, very quickly understand what's going on market wide and decide if what is happening is really worth it or not. Is it just some weird panic selling? What is it? And so I'm going to get into the main way that I use it a little bit later. But for now, we're just going to get started with the basics of how do you draw it? Where do you draw it? And why do we use what we use to draw it? And so for me, I base my opening range on the first hour and a half of the day. There's, other people have kind of taken this idea and adjusted it to what they like to use. There's one of the big Furu guys out there, he uses this, but he uses it based on an hour, and he calls it a dealing range. And so he uses it based on the first hour of the day. I like to use the first hour and a half of the day for multiple reasons. One, just experimenting with it and seeing that in the first hour and a half of the day, you get much better reactions at that level than you get at the first hour of the day level. There is, of course, times and places where it happens in the first hour and that's all you needed. And there's times where maybe you break one candle below the hour and a half, and that actually ends up being the lower high a day, whatever it might be. So with the opening range, and we're just gonna go blank chart. Oop, um, we're just gonna go blank chart here. Uh, I guess it's not gonna be blank for us, of course. Let's see. Yeah, we can clear that all up. So blank chart. We come into the day, and a lot of you have heard me say it, and you don't have to like buy into this or anything, or you don't have to follow this rule. But something that I think really would benefit a lot of people is letting the market open and then letting it work for a little bit. I'm not going to say sit there and do nothing for the first hour and a half, but I wouldn't tell you you're wrong for doing it. But definitely avoid kind of this early part in the day. And the reason that we want to avoid that, and don't get me wrong, there can be very, very good, profitable trades earlier in the day, but they're high risk. And so that's going to lead to some of the first statistics that we're going to talk about tonight. And one of them is based on the candle, what is the percent chance that the high or low of day has been set? And so today's a funny day that we're going to talk about it because this is one of those, very, very rare days where it actually didn't work. And so when we're looking at candles and we're looking at where we are in the day, a really useful statistic is to know, statistically speaking, what's the high, what are the chances high or low has been set? So on the first candle of the day, believe it or not, there is actually statistically a 20% chance that this will either be the low or the low or the high of the day. Just based on the first candle, that first one opening, we got a 20% chance that it's going to happen. As we get in, a few more candles, as we get into, say the seventh candle of the day, give or take, we're having some exponential growth. And there's actually a 50% chance now that the high or low of day has been set. And again, I want to emphasize, I'm not making these statistics up. This is, work that I did not do, that somebody else did, that put in many, many, many years to figure this out. So by the seventh candle of the day, we're talking a 50% chance. Well, the one that I like to, or the one that a lot of people like to do, your first hour of the day. So once you've made it an hour into the day, there's actually a 70% chance that high or low of day has been set. And so you can use that statistic. That's good. It's 70% chance is good. Well, I like to wait for the first hour and a half of the day. And so that puts me, it's 8 o'clock my time, it's 11 o'clock Eastern. And once that has happened, that is when you guys see I post in my tab every single day. I post a chart, and the chart is going to look something like this. And then I like to make it green because the gray is kind of like bright on the eyes. So I make it green, and I have this box and I post it in my tab every single day. Well, how did I find it? I put the top of the box up here at the highest high. And then I put the low of the box down here at the lowest low. So I'm looking for the first hour and a half of the day, and it's right here. This is when it's technically set, but this low was lower. So this is where it goes. We now have the highest high and the lowest low of the day. And that's our opening range. And that is what we trade around. It's that simple to draw. You can use it on every single chart. We'll get into that a little bit later and some of the ways you can use it, but it's very simple to draw and it's very easy to trade around. So now that the opening range has been set, we know that we have a 90% chance that higher low day has been set. As I pointed out earlier, or said earlier, this is one of those rare days where we broke it. We were in that 10%. We weren't in that 90%. We were in that 10% where this was our highest high, and we ultimately set a higher high by the end of the day. And so it's just one of those days where it didn't work out, but we can still take trades off of this regardless of if that statistic plays out for us. And so I hope everybody understands, super easy to draw. Now we're going to get into a little bit more of the technical stuff that we can look at, some ways that we're actually able to use the opening range for intraday trades, on SPY, on QQQ, on IWM, on anything that you want. I use it on all charts every single day, but I frequently take trades where a large part of the thesis is based around the opening range. And when I'm doing those types of trades, I will typically be trading Spire QQQ just because they react really well to it. They're extremely liquid. A bunch, most traders in the market are making trades on SPY and QQQ every single day. And that's not just, I'm not talking retail traders. I'm talking big money and hedge funds and algos and, the high frequency firms, and they're using SPY all day, every single day. So it can react really well to those statistical levels. It's kind of why fibs work. It's all of that kind of stuff. So I'm actually going to pull up the chart that I have been trading. Oops, wrong one. The chart that I have been trading, we'll get rid of my trend lines that I was using, and we're going to pull up the chart that I've been trading. And then we're going to talk about how did I use the opening range today? What are some things that I looked for during the opening range being set? And how could I have taken trades here? So as I said, we kind of ignore this early movement. You can take trades here, like I said, but not a lot of interest here. Well, where I start to have interest is as we get closer to this opening range being set. So again, I give this disclaimer every single time that we're hindsight trading right now when we get to go back and look at these charts. So we get to pretend we do everything right. And maybe during market hours, it's not going to go this smooth. It rarely does go this smooth. And so, that's a bit of caution that I always try to put out there, that we get to pretend we're better than we are when we do hindsight trading. If there's anybody that you listen to that all they ever do is show you hindsight trading and, say, oh, I took this trade, but they tell you after the fact, always be pretty leery of it, make sure that people are reliable if all you see from them is hindsight trading. But opening range and some things that I look for. Well, the first point where I really start having interest, and I think I did trade a little bit here early in the day, is, and I'm going to show you just exactly how I would look at this chart. So the first thing that I'm going to have here is going to be this trend. It's from the pre-market. We sell down to it, kind of bounce, and then ultimately flush right below it. At that point, I'm now interested in a trade. The market has made a large move. And so I want to say, what do I think the market is going to do? We, of course, at this point in the day, this is only, 10:10 Eastern time. So we don't have the opening range set by my standards. We're only an hour into the day or whatever it is. And so we don't have the opening range set. And then we get a nice volatile bounce here up to a very, very major level. So when we are up here and we're getting on in time, we're to 10:30, 10:45 Eastern time, that is when I start to look for a trade and I start to see, okay, opening range is going to be set here really, really soon. So I start to look for a trade, and the first one that I see is going to be a double bottom right here. I don't know if I caught this trade or not today, but the first thing that I'm going to look for is going to be some sort of double bottom. We set a low, we bounced up, and we're basically just printing inside candles. So not a lot of interest in trading right here. I know a lot of people were trying to. As I said, if you're scalping off of this big 547 level, you can be making money, but you have to be quick. Really, the interesting one is this wick right here down to these lows, again, targeting up to here. Well, the wick is set about 10 minutes before opening ranges. So we're just using that ballpark. We know back here at an hour into the day, we got a 70% chance that higher low day has been set. Then right here, we're now 10 minutes away. So we're pushing 80, 85% chance that the higher low of day has been set. And this is when I like to talk about my next favorite statistic. And it's one that I use literally every single day in trading. And I think that if people consciously thought about it a lot more, then it would really, really help them in their trading. And that statistic is that 80% of breakouts fail. So when SK already knows, he's saying it, 80% of breakouts fail. So never be the one hunting the breakout. if you can catch the breakout with a good entry, then great, but never be the one. And, that's breakout or breakdown. I use it both ways, and so breakout or breakdown, never be the one chasing it, and never be the one chasing it. It's something like a double bottom. So we know maybe we catch this trade, maybe we don't, but this is where we have interest. We have a double bottom. Well, we get good buying. If you're in this trade, you made money. I'm not going to say I was in that trade. I have no clue at this point. But if you were in this trade, you made money. And you could even say you got your little trend break here. You made money. Well, we still know that now we know opening range is set. 90% chance higher low of day has been set. We have now technically at this point set a lower high. Once these two candles form right here, and you can draw it off the green or the red one, I don't care, I'm impartial, once these two candles form right here, you have now set a lower high. So now you have to start leaning towards the fact that we've set high of day, because when we're kind of trading down here and we're down here, below this high of day, we're trading closer to, the lows of the day. We're setting things like lower highs. We've already broken one daily trend, or one intraday trend. Then we start to look short. And I understand, people wanting to look short. This is a really tricky one here. Could you short this candle? Yes. But we know that 547 has been really, really hard. Well, to either break above, if we break above it, we typically push. If we break below it, we typically flush. And that's been going on, not just for, we'll buy up to it, take a big flush off it. This isn't just a 1-day thing. Again, break that 547. And that was where the water falling really started a few days ago. That 547 to us is crucial. I mean, bounced it to the wick there. So we know 547 is big. You are risky shorting above it. So what you do is you look for a bounce to short when it breaks. And we're looking for that bounce to short because we're starting to believe high of day has been set. We have set a lower high. Sellers were winning on the day at this point, and because we're down, and so sellers were winning on the day at this point. So we look for a bounce to short on the break of 547. This is it. Tight stop over 547. Obviously, looser stop is going to be over the trend, but that's going to be a decent whack-in if you take that. And then you target the low of the range. Today is a day where if you were in it, we sliced it, so there was nobody looking for a triple bottom would have entered this trade because we went through it so fast. And then a good question. I see your question. Do you short once and hey, Narvin, can you save it to the end for once? So I always wait for a candle to close for my confirmation. I consider that, and it's an Al Brooks term, but I consider that a signal candle. It's telling you to look for the trade. So we know when this candle is closing way down here, we are looking to short the next bounce up. So as this candle is forming, we're already getting ready for it. But we need this candle to close because everybody's seen, the ends of those 5 and 15-minute candles. Insane stuff can happen. You can have the ugliest candle turn into like the most bullish candle ever by the end, So you let the candle close. Then when this new one opens, you decide, how much risk do you want to put on it? And if this thing's bouncing up there to 546.90 or whatever, you're only 10 to 15 cents before your level. So this is a reasonable enough entry. Obviously, you aren't going to top tick the puts or anything, but this is the candle where you enter on, likely mid candle. And then if you're really looking for a scalp, if this candle closes above 547, you likely take the instant stop out. It can be on the very, very same candle. If you're looking for more of a day trade, that's where you widen your stop out. If the trend ends up breaking, you take your stop. But if it rejects down, then you got to keep riding the trade. But this will be a candle that you short during it. Then you target the opening range low. As I was saying, this is a day where you just absolutely knifed through it, sold right to this next level, absolutely knifed to the next level. So if you got lucky, great. Who cares? We don't care about the profit. We're just discussing how we use the opening range. And the opening range gave us our statistic that, we believe there's a 90% chance that higher low of day has been set. And when we're setting lower highs, it's starting to look like high of day has been set. So we start looking short. Then you get the nice short down. And as always, you have to think big picture. So what I do when I see a big sell like that is I go to the daily time frame and I take a look at where we were trading. And so you can see these are the gap levels, the previous gap levels, and we have the previous gap from right here. 547 is from all of these wicks is originally what it's from. Happens to line up almost dead center with the gap. And then we got two pretty big levels down here. We got the low of the gap, which yes, it is filled. And then we had this big 544.19 level, which is the 61.8 fib off of that retrace that I've showed you all how to do it from that August, September sell-off. And so we know we have two very big levels here. So we want to take that into context of our trading and say, do I really want to be short down here? And if we do, I don't personally, because I always go back to the statistic of most breakouts fail. And this one broke out and is super winning right now, no questions asked, but I won't short this. First break of two major levels. We did it in a couple candles. The retrace makes sense. So I sat here and I watched these candles form. And then nothing. All of a sudden I started to have interest here. We had a candle close above it. We had a couple of inside candles. Now we have almost breaking of these highs, closing above our level, retesting it for a whole candle. Then we get to watch this whole candle form. And then at that point, we get to say to ourselves, okay, I want to look into a trade. And this is one that I lucked out and did catch today. So we sold heavy, we broke our levels. Now we have two targets in mind. The very first target is here. And obviously, the very next target is the opening range low. And this is a day where, we were breaking statistics, but we have to say to ourselves, 80% of breakouts fail, 80% of breakdowns fail. And that works both ways. So when this breakdown worked, well, now we want to look for a couple candles trying to break above this to convince us. And so we get this one, which works, and then fails, and then kind of works-ish, and then finally have one that holds. So we aren't interested in trades here. It took us our 3 or 4 candles to really break back into here and hold it. And now at this point, we can start to look to play some calls. Again, you aren't always going to get big ripping candles like this that run straight to a trend. But if we're holding back into the opening range, we now have to go back to our mindset of, most breakouts aren't going to hold. Most breakdowns aren't going to hold. At this point, this breakdown has officially become a failed breakdown because it broke down and then it failed. If you zoom out to longer time frames, as I frequently recommend, in the very next candle after the breakdown, you were back in the range, and on the next one, you're ripping, So that breakdown in the end technically ended up being a failure, a very good paying failure, don't get me wrong, but now we're back in the range. We assume breakdowns, we assume we aren't going to break down, and this is where we can start looking to get long again. And maybe you catch this ripper. None of that matters. This is just where we can look to get long. And then for anybody wondering, where are our stops? Outside of the opening range. It does everything for us. And we're keeping this really cut and dry. You need to be watching volume. If you got EMAs, you need to be using EMAs. You need to use your VWAP, Bollinger Bands, any of those things to give you some information of what the market is going to do. We're just discussing some of the things you can look for in the opening range. So once we've broken back in, this is one of those ones where, people ask me all the time, like, oh, should we short SPY here? And my responses are typically like, why short it after it's sold $2.50? Like, sure, maybe you can get some more, but you got to feel like you're chasing. Well, this is one of those situations where we buy it back up and then we actually get a little bit of confirmation to look for longs. So is it up $2 off lows? Yes, but we're seeing buyers show up. We're breaking above levels. We're holding above levels. We're breaking back into the opening range. Likely we're above EMAs. We're getting above or close to VWAP. So we have things in our favor to say, look for calls here. And that opening range just gives us the cut and dry thing. Enter longs above the opening range at these lows and look for a bounce. It's the same as up here. I guess we can just continue discussing it because it's, those are my favorite things about the opening range is assuming a breakout isn't going to fail and looking for double tops and double bottoms within the opening range. So this double bottom, technically even a little bit of a higher low, would have paid awesome if you caught it. Maybe you didn't. Obviously, we knifed through here, so there was never a possibility to even get in another double or triple bottom trade. Well, maybe you catch this breakout, works out nice for you. We get the consolidation around 547, breaks out again. I really got no interest in chasing this, you know. We got highs here, we got highs over here. Did we ultimately end up pushing? Yes. Well, the first trade that I'm really going to be looking to take, you know, if you didn't catch this move, is going to be a short as we come into the top of the opening range up here. So this was a lucky day where, you know, that same gap low that we were trading by, well, I'm going to do the exact same thing on the upside. I'm going to assume that the gap top and that level are also not going to break. So the trade that I'm looking for is a short here. And why am I looking for a short there? Because it's a double top. And your stop, it all depends on where you get your entry and what you want to do. I'm likely going to let this first candle play out. And then I would personally let this second candle play out. But really, the touch of this gap top level is where, and I also want to emphasize, let's pretend this isn't 15 minutes to close, you know? We'll just say, you know, pretend this is the middle of the day, because I'm not trying to promote, you know, counter trend trades 15 minutes into the end of the day. So pretend this happened earlier. You get the double top here, short this red candle, and your stop is just a new high of day. You're going to be risking 25, 30 cent move against you. It could come quick, so have that stop loss set, or you ultimately sell to right all of these wicks, ultimately where you think you should bounce. So that is where I would love that trade off of the opening range. And so that's how I use it throughout the day. I have it help me build my bias. You know, because the market can work both ways. Let's look for a different kind of day. Um, we've just had so much volatility lately. Oh, here's another one. Even still has the opening range drawn on there. So this is another one, even better example of the potential double top. It is before the opening range is set, but we know we're getting pretty close to set. So we look for a double top up here, and you short this double top up here. And again, stop on the new high a day. Maybe you don't short this candle, you wait for this bounce up, stop on a break over that candle, and it works both ways. Now down here, we break down, and this is nice because this is what I want to show you. We break down, you short these retests. We are staying outside of it. You know, we sold below, we bought back up, we closed below it. You short the bounce with a tight stop overhead. Then again, we come back into here, opening range. It tried to break back in. Very, very reasonable double top short right here for, again, a continued push down. A lot of people know I like to long the bottoms and short the tops, but this is one where the price action makes it really obvious they aren't holding on to it. So when you get the double top up here, even though it's down low, you know, double top low on the day, you look to short that thing. You can look to long these double bottoms down here, again, targeting back to the high of day, stops on, or back to the opening range, stops on low of day. You know, anywhere down here is where your stop is. You're going to risk 40 cents, something like that. And you're looking for the opening range. The opening range should always be, at least for me, it's my main target. If I catch this bounce up into it, I'm completely out right here, because I'm going to assume the break back in is going to fail, and we aren't getting convincing candles to say otherwise. Same as this one. We've sold down, we get an inside candle. You know your stops are here, so that's where your risk reward is. And just keep it, you know, very, very simple, very, very cut and dry. You can use it on everything. You know, I mean, I use it, this is going to segue into the next part. I use it on everything. I use it on QQQ. I use it on SPY. I use it on IWM. And just trade these major things. You will frequently see, since SPY is basically big tech too at this point, and has been for a while. A lot of the time, those QQQ and SPY charts are going to do relatively similar things. You know, the turnarounds will come at the same time, that kind of stuff. But you can see right here, even just super simple cut and dry on QQQ today, we broke below this level, big 38.2 level, reclaim it, reclaim the opening range, reclaim this test of the opening range where you enter calls. And it feels weird down day, trend is down, setting lower highs still. Nice turnaround, but you enter calls here, stop below 454. Very, very low risk. And this is just using the opening range. Generally speaking, I am going to recommend using some amount of a mental stop because the market's great at wicking when you have important levels that actually work and are good. The market's really great at wicking those levels and stopping you out. So I typically recommend a mental stop. The risk of that is, of course, that you can get blown out pretty good. So make sure you do have a place in your mind where you're going to say, I'm calling it quits. Maybe your planned stop is below here, your 25-cent drop. Well, maybe the candle closes down here. So you end up taking on more risk than you planned, but maybe it wicks down to here and buys up before that candle closes. And that's why you want to use a mental stop. But if you have a bad job at clicking sell when your positions are red, then I always just recommend using a hard stop, bump it down a couple bucks lower than where you think it should be, and go with it. And so, yep, that's QQQ. So now we're going to get into there's a million things to teach about the opening range, a million different strategies to look for with inside of it, or when we're inside of it, things that might give us ideas that, a breakout is going to come today or a breakdown is going to come today. But we aren't going to get into a lot of that just yet. The other things that I always think people should watch for is any sort of range, a bunch of inside candles, look for those kinds of things within the opening range. This was an interesting one, and I was getting all kinds of questions and DMs at this time to trade it. And you guys saw the only one I liked really was the double bottom here. If you were a scalper, shorten the 547, which eventually caught up to you right here. But it's just a range. And all of these, and if you're a stickler, I get it. Maybe this one right here is not an inside candle. All of these candles are an inside candle of this one. So really, this is like your first break of a big old range, very tradable range, of course, but a break of a big old range. So always look for those ranges within the opening range because they can be a very, very good, setup. They can pay you very well. You might not get the breakdown, but you'll get a nice move on those range breaks. And so the next thing I'm going to cover is, and I kind of talked about it in my description of this class, is how I use this to really analyze the whole market. And so for these examples, or this example that I'm going to give today, because it was something that I was personally watching. So I always love it when I have to give a class at night and I have an example from the day of. And so I love the opening range. I use it on everything. I've said it a couple of times during this class, Apple, Amazon, Microsoft, Google, Nvidia. I don't care. I have the opening range on there. I assume the opening range highs aren't going to break. I assume the opening range lows aren't going to break. If they do, then I'll trade them and I'll look for, some sort of continuation because we know if that break comes, then that we have a very high probability of either a bear, on today, when this one broke, we had a very high probability of either a bear trend day, which we only got 3 more candles of, or a trading range day. Typically, you would assume it would stay in this lower section trading down here, but today was, V-shaped recovery. Those are rare, happen like 5% of days or something like that. And so big V-shaped recovery. Well, we have our levels, but maybe some people, they aren't as good at charting support and resistance, and they need something that's a little bit more cut and dry for them because, support and resistance does, as much as I hate to say it, involves some feelings, This 547.07 that I have is kind of an example just to show what I mean. We're over here and we have all these wicks, and this is where that level came from for me. Well, this one was actually up here at 547.50-ish or something. This one was at 547.30. This one was give or take 547.07. This one was 547.40. I wanted all of them. So I fudged it and I put it at 547.07. That's where it ended up. Am I going to worry about that to the penny? No, but I am going to think of basically 547 up to about 540.30 or 547.30 as a little range to, be cautious if I'm long until it breaks or feel more comfortable shorting. Well, today was the day where, we sold down some big levels, but if you didn't have them, maybe you weren't looking for the bounce. I saw a lot of people calling, oh, we're gonna go see these Friday lows, or Monday lows, sorry. And oh, we're gonna go see those. And maybe, but since I tend to think that my big levels are gonna hold, I do something a little bit different than others do. And so for this example, I apologize for anybody that's watching this on a phone because it's going to get crowded. So, but I want to show an example of how I use the opening range to really analyze the overall market. And so the great example today is QQQ. So we have the opening range on QQQ and we've broken out of it. And so that's when I start to feel, I wonder, I'm like, well, that's weird. We broke out. The market, what I always try to teach people is the market doesn't like to set new highs and lows. It likes to just stay in a range. So when I see us breaking out up or down, I start to look and say, okay, well, what's going on in the market to be causing this breakdown? And so how I do that is I look at some of these other major names. And so the main ones that I watch, and I'm only going to pull up three of them. The main ones that I watch personally are Microsoft, Apple, Amazon, and Nvidia. But I watch Nvidia a little bit less because it can kind of just go off and do its own thing. But I like to look at these and then say to myself, what are they doing? And are they backing up this move that we're seeing? And so today is just this wonderful example of the opening range was the initial hint to, at least for me and for how I trade, to tell you to be a dip buyer and look for that dip, because if they dipped it outside of the opening range, they were likely going to bring it back inside of it. And what made me see that was over here. So this is basically 8:50 to 9 o'clock my time. So that's going to be 11 to noon Eastern time. And the opening range is way up here. And we have broken out of it. Well, when I look at these major names, here's Apple at the exact same time, setting a higher low. Here's Microsoft, at the exact same time, setting a higher low inside of the opening range, inside of the opening range. Amazon, right down here, setting a higher low inside of the opening range. But somehow QQQ is broken out. So then you have to ask yourself, are they going to buy this or are they going to sell all of the big names? Those are the only two options that happens here. So then I have to go looking. And so today was the day where Nvidia was in fact outside of its opening range. And I believe Google was the other one that I saw. Yep, Google was outside of its opening range, but not much, a little breakdown on it outside of its opening range. So I got 3 of the 5 big names setting higher lows within the opening range. And now I start to see signs of basing on Nvidia. I started to see signs of basing, real quick turnaround on Google, like it did not want to stay down there. Nvidia took a little bit more to break back inside. Well, we get Nvidia back inside, we get Google back inside, we got Apple, Amazon, Microsoft all already inside and setting higher lows. That's when I start to look to buy the dip, because the market is telling us we're actually going to buy these things. And so, like I said, this was a trade that I took today on SPY, and we had a very similar thing going on SPY. Even worse, SPY is outside of the opening range. So I did the exact same thing. I said, what's selling SPY? Because it's not tech. So I went to XLF, clobbered, and outside of its opening range and selling and selling and selling. And then I went to XLE, which was not outside of its opening range, but was in, having a very bad day and selling and still selling down. So now I have my answer of why SPY is selling, and it's because XLE at one point was down like 2%, and XLF was down probably around the same, if not even more. And so now I have my answer of why SPY is selling. So that's how I look at the overall market. I've now looked at basically all of tech that matters. I've looked at XLF and XLE, and I've made my assumptions of what the market is going to do. And when we got XLE, still selling, we got XLF actually suddenly trying to bounce. We have all of the big tech names coming back in, either within their opening range, setting higher lows, or if they aren't within their opening range, they're now buying back into it. So it brings us back to my trade that I took, and I'm just going to make this chart a little bit bigger so we can see it. This is when all of that was going on. So when I see all the big names are back in, XLF is buying, XLE is the one thing still sliding a little bit. We've reclaimed my big 61.8 level. That's why I took this trade right here, because I used the opening range to analyze the entire market, you aren't obviously analyzing the entire market, but you're looking at the 4 or 5 biggest stocks in the American market, and then you're looking at the entire financial and energy sector as SPY. And just from those, 6 or 7 charts, you now know what the market is trying to do. So you're able to look into buy that dip. You don't want to be targeting way up here, of course, but you have a very reasonable purchase on a dip by here, maybe stops on low a day, 50 cents below you, or sell up here about $1.20 above you, and make a nice return there. Target the opening range, target the trend, keep those things realistic. You don't want to be the person, we're down here trading 544. You don't want to be the person in 548 calls praying that we absolutely fly. You just want to say, okay, the market has given me basically 7 or 8 reasons to be a dip buyer. I'm going to be a dip buyer with a reasonable strike and reasonable targets. And I picked up all of this information. You don't even need levels on these when you're just analyzing them. You just want to say, what are we doing at the opening range? And if most things are in the opening range, and those major ETFs are not in the opening range, SPY and QQQ, one of 2 things is going to happen. The other stocks are going to go out of their opening range, or the ETFs are going to go back into their opening range. And today was one of those days where, we had people chasing puts at lows, but we had big tech stocks setting higher lows on their charts. So it was a tricky trade to catch, but really nice one when you just kind of looked at the whole market and said to yourself, wow, there's a lot of reasons to buy and very, very few reasons to sell. So that was just a nice example of today, a market that was fresh in everybody's mind, where the opening range was like, it was really all you needed to trade around today, and you were provided a few really, really nice trades that ended up doing really nice things for you. So that's really all I got on it for right now. As I said, you can get really, really advanced with this thing, but that was just the major points that I wanted to touch on. If we're within the range, just to kind of give the bullet points, if we're within the range, I am always looking for things like double tops, double bottoms, retests of lows, and then any of these retests of highs, and taking the counter trend trade. I always want to be short with a tight stop at the highs, and I always want to be long with a tight stop at the lows. And this doesn't mean, buying mid candle while we're knifing. It doesn't mean anything like that, but you want to look for repeatable patterns. We want to see this one selling down and then see some buyers show up, and maybe you don't bottom ticket, but maybe you're able to get in up here and know you got about a 25-cent risk. You can even set a hard stop. You're good to go. So we know we want to look for those types of trades. We know that there's a 90% chance that higher low of day has been set early in the day. Obviously today we didn't, that didn't work out for us. But we know there's a very high chance higher low of day has been set. And then we know that most breakouts are going to fail. So we want to plan for the market to stay within the range, and the best risk reward trades are going to come at those extremes. Today was an interesting day with 547 right in the middle. There was some trades to be had in the middle, but generally speaking, I'm not going to be looking for trades on the ETFs unless we're at these major areas, and just keep using those statistics. And, as I said, I use the first 18 candles of the day, first hour and a half of the day. I use that. It's the one that for me and for how I trade provides the most dramatic reactions. But that doesn't mean it's the only right way. Maybe you're trading this and you find you like the 20th candle, or maybe you like the 15th candle. Just find what works for you and works for your trading style, and then kind of try to apply it to all charts and really use it to help you analyze, the market and see what the market is doing as a whole. And when we're in the opening range and everything's in the opening range, plan on range trading and don't go looking for breakouts when everything is outside of the opening range. Because I should say, my example today was most things were inside the opening range and the ETFs were out. Well, it can work the other way, where you might have Apple, Amazon, Microsoft, Google all broken out of the opening range and QQQ's still in it. That's when you can kind of start to say, hey, I think QQQ might break out. And maybe it works for you, maybe it doesn't, but it can work both ways, where you have more things inside of it, you assume the ETFs are coming or whatever's coming back in. You got more things outside of it, and you start to assume the ones that aren't outside of it yet will be outside of it sooner than later. So that's it. That's my spiel on it. We got a few extra minutes for questions, 5-10 minutes left for questions, or I've been trying to leave extra time at the ends of all of these to maybe just look at some charts, just do a little bit of charting. But if anybody has questions on opening range, I know I've taught about this a few times. Let me know. Or if anybody wants some charts done, if old Norberto's in here anymore, I'm sure he'll ask for one, but maybe he's left. Otherwise, we can always call it early, but happy to answer any questions. And if you got to get out of here, of course, as always, thank you for being here. Oh, there's Norberto. Oh, you swung puts. Weren't you Mr. Bull guy like all day? I mean, you have CPI tomorrow, so no matter what, it was like a big old gamble, But to me, this isn't really where I like QQQ has a couple of trends going on right now. Well, beyond, this big major one over here, obviously. But that was one I was watching, and then the other one that I was watching was this one. And to watch us push down to support, push back up to the trend, fail the trend, and then ultimately break back above the trend. To me, this is looking pretty bouncy. It's all up to CPI tomorrow. I think that's tomorrow. And then the other trend that we also have going for us, this is one that I was sending to my buddy. And these are short trends, but we got this nice little 4-hour trend going on where, and I set it off a year. We've had attempted breaks below it. To me, if CPI wasn't tomorrow, I definitely would have been on the long swing today, likely looking for at least to push up to 460 if I was lucky, going to be up to that, higher trend, at least to 460, maybe a little pop up here, 461, 462. But with data tomorrow, all bets are off. But definitely not a candle or a trade I would have been swinging short on, especially closing over these previous lows. But CPI could dump it, and I'm sure you will tag me tomorrow if CPI dumps it and I'm wrong. Right on, SK. Thank you. Yeah, T. I love the opening range. It's just so easy. And that's my favorite thing about it. You guys know I love the easy trades, the simple trades. And like, oh my God, it just works so good. And like, I mean, the guy who teaches it, he's a big futures trader, The futures people, it is a ridiculous payday. I mean, if you trade the opening range on futures, it is disgustingly profitable. I mean, you of course aren't going to bottom ticket, but these types of candles on futures, you get yourself the 11, 12 point rip on futures. That's a nice little $600-700 candle right there. So for quick futures traders, not like, hold all dayers crazies, people who scalp futures, which, is according to most profitable futures traders, really the most profitable thing you can do, those 2 to 5 candle trades. But if you scalp these things off the opening range, it is just ridiculous. I mean, 54.70 up to 54.90, it's $1,000 trade for you right there on one contract. That ain't too bad. Yeah, Al Brooks, price action. Oh, you got stopped on AVGO? How? False? Why would you stop out on this? And how could you be red on this? Oh, you probably stopped out back here yesterday. Opening range study is in it is in my tab. It's pinned in there. If you don't find it, let me know and I'll get it sent over to you, no problem. Yeah, awesome. Back test away. And then also rest assured that Al Brooks, I believe it's gone back 75 years is what those statistics are off. Those opening range statistics. So he's done a lot of looking. He's done a lot of looking. I used to actually be in a group where he would talk. I don't know the guy or anything, but he'd talk every once in a while. And somebody joked at one point that it had like something like 20,000 days of back testing done on it. So he's put in the work. Yep. Because Al Brooks is real. He's not like these new like Furu people, He's a real day trader that has done it since the 80s. He's buddies with real day traders. He's not, and he's old now. I mean, God, he's got to be 75 or 80. He's an old guy. So it's all just what he saw from 40 years working in the markets and trading on his own in the markets. So he had that like unbiasedness where he just found things that he liked and worked and went with it. Yep. Al Brooks price action. One of the few worth listening to. Okay, well, I'm not seeing any questions, no charts, no nothing. Thank you all for being here. I really appreciate it. As always, all my regulars always here. Thank you so much. For anybody who's never been to one of my lectures, thanks for being here. Hope you learned something, and let's get after them tomorrow. Yep. Thank you, everybody. Yep, right on. Thank you all so much, and we will see you all tomorrow. Have a good night.